Welcome, everybody, to the Tennessee Valley Federal Credit Union October Virtual Mortgage Seminar. I'm Eric Weekley, Vice President of Mortgage Lending with Tennessee Valley Federal Credit Union. And today I'm joined by Cassie Sparks with Lead Your Financials. Welcome, Cassie.
Thank you.
We appreciate you being here with us today to talk about credit monitoring and credit report fix. And so with that, just, take a few minutes, if you will, and kind of tell us and our listeners what it is that you do.
Okay, awesome. Well, thank you for inviting me.
Absolutely.
So with credit restoration, what we do, we are a consumer credit restoration company, Lead Your Financials, that of course is based out of Chattanooga. So we help clients that are nationwide in restoring their credit. That will allow them to do things such as purchasing their home, whether it's their first time home or an investment property, but just getting their credit cleaned up to where they can become to a state where they can get approved for a mortgage.
Okay, great. So Cassie, for those that may not be familiar with credit repair or work on what you can do with your credit, what kind of credentials do you have to acquire to be able to assist consumers with a process like this?
So with becoming a credit repair specialist, I'm actually certified through the Credit Consultant Association, although that's not a requirement. Anyone, of course, can work on their own credit, just like if you're wanting to change your own oil. So you can do those things on your own. What we do is provide our clients and our customers kind of the giving them the service without all of the giving them that without them having to know all of the knowledge about the Fair Credit Reporting Act, the Fair Debt Practice Collections Act.
Mm-hmm.
So in addition to the FTC and the CFPB, so those are the things that we do. So we are experts in that area. We are subject matter experts in that area. So that's what has allowed us to become successful with assisting those clients.
Okay, so in essence, the consumers can contact you for this need and you'll guide them through the process.
Exactly.
Good. Okay. So if a consumer comes to you and says, I think I need to work on my credit, what do you do to prepare them, or where do you take it from there?
So great question. So what we usually do is have them to pull their credit report. Through using credit monitoring, or if they already have, in some cases, if they've been denied a mortgage loan,
okay,
they may already have that mortgage report. So we'll get a copy of that report. We scrutinize it with the consumer, and basically just doing a consultation to let them know what areas that we need to work on in order to get them to have an improved score. So outside of just the score, we want to make sure that that consumer has an overall healthy credit report. We have seen customers or seen clients get denied that they have a score of 700,
mm-hmm,
but it's not necessarily just the score. They don't have enough of content within their credit profile that would allow the underwriter to approve them for the loan. So we don't just necessarily focus on the score. We want to make sure that overall you have a healthy credit report.
Okay, so speaking of the content, what do you look for?
So all five categories. We're looking at the payment history. We're looking at their credit utilization. We're looking at their inquiries. We're looking at the diversified accounts. We're also looking at their either way, we're looking at all five of those categories, looking to make sure that they have substantial content with each of the categories. So for instance, a lot of clients don't have a credit card, or they've maxed that card out. So we basically set up like an individualized plan, because no two people are alike.
Right.
So we set up an individualized action plan for them, and basically just kind of setting them up on a timeline. So if it's where a client needs to be approved within 30 days or within a short time period, we will give them some gestures of what they can do to improve it. Typically, our average client stays with us for 6 months or less, or could be up to a year, depending on the complexity of their credit report. So if they have a lot of public records, those things do take a little bit more time to get off. And not only that, we want to make sure that the client is not adding anything outside of the action plan that we have suggested for them.
Okay. So a term that comes to my mind in the mortgage lending space is trade lines. what do healthy trade lines look like in your world?
Great question. So healthy trade lines would be 2 to 3 credit cards, 2 installment loans or more, and of course a mortgage. But of course, a lot of our clients' goal is to get approved for that mortgage. So we do have clients that, although they have a high score, they may have 6 or 7 credit cards or 8 or more credit cards. So we work with them strategically to get those credit cards down to what we call kind of like our perfect credit pie or an appropriate credit pie. So we're working with them to get those things paid down or either closed down to a acceptable amount of credit cards, because they can be denied for having too much credit extended. So those are some of the things that we do to help that client overall. And then just kind of doing again, with doing the timeline, because every wound takes a little time to heal. So letting them know that, with the time that it takes to get a response back from the credit bureau, in the meantime, we're going to be working on other credit education tips for the client. You're teaching them how to use a credit card, teaching them for what loans to apply for, teaching them when to either refinance a particular loan. So just teaching them some other things that are going to be useful for once they graduate our program.
That's all great information, Cassie, for our listeners. What information should a consumer prepare or bring with them to a meeting with you?
Really nothing. So once they're ready to get started on restoring their credit, or if they have questions on what they can do, we offer a free consultation because we understand that we may not be, or every client may not be a great fit for us, depending on their timeline. So we want to make sure that we're very transparent throughout the entire the time that they're enrolled in our program. But we also want to make sure that we can give them some tidbits and some nuggets that will help them to kind of improve their credit on their own.
Okay. So a consumer reaches out to you and your group and they say, I think I need to do this. I think I've been denied for a mortgage or another type of loan, or I know I've got collections, or whatever the case may be. What are the next steps?
So great question. So the next steps are basically once they acknowledge that they want to be a part of our program, we are basically their advocates. So we go over their credit report with a fine comb with them to make sure and to see what accounts do we need to dispute on their behalf. So basically kind of looking at it from an investigation standpoint. So we want to know kind of what either got them in the situation, to see what happened at that time. And we're writing those dispute letters on their behalf. And so either way, just making sure that we are adhering to the Credit Repair Organization Act, in addition to using the consumer laws to help get those items removed. Most consumers don't realize that nearly 80% of credit reports contains errors, whether it's with your personal information or with the trade lines, as you had discussed, or it can be as simple as merged accounts. Or just information that's simply not yours on there. So that's the reason that we go over every credit report with the consumer. Although a lot of consumers do attempt to restore their credit on their own, a lot get defeated after the first couple of months, and so they give up. So that's where we come into play, and that's why a lot of consumers like to go ahead and save that time and that stress and just go ahead and hire us to help them or to be their advocate on their behalf.
Okay, great. So consumer comes in and meets with you and your group, and you've gone through all of this. What kind of guarantee is there that the credit report repair will work, for all, or if not all? I mean, what are the chances there that it may not work?
So what we offer, there is no 100% guarantee that everything will be either removed or deleted or even updated. But what we do offer is a guarantee that if we are unable to delete anything off of your credit report within 180 days of starting with us, or basically 6 months, then we reimburse you back your monthly payments. So it just kind of provides our consumers the extra protection or the extra sense of security that we are working for them on their behalf. Not only that, each consumer has their own portal, basically where they're able to see the work that we're conducting on their behalf. So it provides that ethical standpoint for us that we want to be as transparent as possible. We also, and especially if it's a client where they've been referred to us either by a lender or by a realtor, we keep in connection with them. So looking at it as a team approach. So where we would keep in connection with them, kind of just the overall status update of their progress while they're in our program. So it allows everybody to kind of stay on the same platform.
That's great. Being, brought up to speed on all that you and your team are doing, of course, because to us, we do this every day.
Right.
Those that are watching, average everyday consumer is not going to know the ins and outs of this. So that being said, is there a downside to reaching out to a credit repair company like yours?
Well, there's the only downside that we have seen, of course, is just like with anything, we want consumers to do their homework. We want them to speak with other credit repair companies. We want them to visit the Better Business Bureau to see if there's any complaints. We also offer, again, outside of the money back guarantee, that's why we do a free consultation, because we want to make sure that we're a good fit for each other. We also kind of want to know not just what their goals are, but what their timeline is. And either way, just kind of helping them once they exit the program. We have yet to kind of experience a downside. Now, we do like to hold our clients accountable. We're holding their hands every step of the way. So that's the only downside would be not contacting us or not working with us, or not following through with their end of the agreement. So.
Yeah, it sounds like accountability is key on both ends. It's key to keeping obtaining and keeping your credit in good standing, and or if it's not working with somebody, but being accountable to that party to help assist in getting that credit back to where it needs to be. All right, so here's a topic or a question that really kind of resonates with me is, what, if anything, can we do in depthly from a credit and financial perspective to be teaching this in our schools?
That's a great question. So I know one of the things that we do, and we start with middle school, teaching them about the basic concept of money, because a lot of middle schoolers, especially as they reach 8th grade, they may hold summer jobs. So teaching them about that. But one of the things that we can do as a community is be more open and transparent about it. Because a lot of kids, they can become authorized users, depending on which state you reside in. They can become authorized users as young as 14. So that helps them when they become 18. However, they also want to monitor their credit between that time period. So it's different than becoming just an authorized user on a parent's or a family or friend's credit card. But if they've maxed that card out the entire time, you don't want your credit to be damaged. So just having that conversation early, teaching them about money early, teaching them how to budget and manage their monthly income and spend within those parameters. A lot of times the buy now, pay later type things that can get a lot of consumers into more financial debt than they had anticipated.
Right.
So just teaching them the impact outside of credit, but a lot of things just come down to management of money.
Okay. So off the wall question here that I wasn't really thinking about earlier, but what about all the stuff you hear about, like Experian Boost and using your utilities and things like that to help boost your credit score? Does that really work?
So, and it can, but it could also be a curse as well. So depending on making sure that you're paying those bills on time. Not only that, if you already have an appropriate amount of trade lines, you don't want to add additional. So it just depends on where you're at in your credit journey. It could be effective for someone who's starting out and don't have an appropriate amount of trade lines to add to their credit report, but it also can hurt someone who already has an abundant amount of trade lines. So it just depends on where you're at. And I would definitely suggest to speak with someone before you take that step to add it to your credit profile.
That's great advice. We do see that from time to time on the credit reports that we pull for members' mortgages, and it's great in some cases. And like you said, a consumer may have enough trade lines where they don't need that, but you know what? I heard this new great thing over here. Let's give it a shot. Doesn't necessarily adversely impact in most cases, but definitely seek out the real reasoning behind whether or not you should or shouldn't do this. So.
Right.
Okay, so let's talking about the Experian Boost and credit scoring apps and things like that are available in the marketplace today. How do we effectively communicate and educate consumers, like with apps like Credit Karma, Credit Sesame, Experian, Equifax, Stringent, all of those? They're tools. They're not true credit reports that you're going to work on or that we're going to see when somebody applies for a mortgage. How do we distinguish between the difference in those scores and really explain that to the consumer?
So of course, education, similar to what you guys do, but we are able to do it more in depth because that's just a part of our program. So teaching the consumer that those scoring models, they use different algorithms. So although it's the same 5 components, they are weighted much differently. And so the difference, of course, between Vantage and FICO The Vantage, of course, basically being more of a consumer credit education monitoring tool. And so either way, also teaching consumers of how it even came about and how the Vantage was created in order to kind of compete against FICO. But once that was lost, or that lawsuit was lost, they are able to sell that to consumers to just be able to simply do that, monitor their scores. So the difference in the variation, so usually it's anywhere between 20 to 40 points difference, and it can go either way. But in the specific to the monitoring apps that you had referenced to, which is Credit Karma and Sesame, most of those only use two credit bureaus. So explaining that to the consumers as well. Not only that, it gives you more of a snapshot. It doesn't go back and give you your credit profile from 3 months ago or 2 months ago. It only gives you your score and how it changed. It doesn't exactly kind of show you exactly what changed. So we advise our clients with using more of and it's nothing wrong with using those for just kind of recording basis. But when you're wanting to use something that you're wanting to use in regards to getting approved for a mortgage loan, we advise our clients, of course, FICO is the best model to use. And of course, within FICO, you have 100 different variations. So, and of course, with mortgage scores using the 3, 4, 5, or 2, 4, and 5 model. So being able to explain that to consumers and how it varies with the different scoring algorithms.
Yeah, we find ourselves telling our members and consumers a lot that, read the fine print. They're based on other consumers that have similarities like yours in your spending habits and the number of trade lines that you have and the types of credit cards and the types of installment loans, or if you've got mortgages, and that when lenders pull credit for a car loan or a credit card or a mortgage loan in our case, it's completely different. Those algorithmic models that you were mentioning are completely different, and you can see vast or varying differences between credit scores, and it could be up or down. So we have to have that conversation a lot. So. All right, so we've talked about a lot of stuff already, how clients or consumers can come to you and your firm and work on their credit. We've talked about education. We've talked about some of the apps that are available in today's world. What haven't we covered? What else do we need to talk about for our listeners and our viewers?
I think that's pretty much it. And what we, of course, advise all of our clients, whether they use our services or not, is to guard your credit. Guard it like you guard anything else, because it is very valuable. And a lot of people don't realize the magnitude until they go to use it. So continuously monitoring your credit and reviewing for any changes that may have come about, getting on the front end early about any new changes to your credit report. Another thing that with collections, and of course with the things that have changed in the medical collection world. So some of the laws that had just recently passed effective July the 1st, where medical collections can no longer report if it's a paid balance. So that's helpful to consumers. And in addition to preparing for a law that's going to pass next July, where a medical collection will not report if it's less than 500. So that's helpful, especially as a lot of consumers have inquired or acquired a lot of medical debt due to COVID or just due to life. So, but just letting them know to monitor their credit reports. Collection agencies typically have a set amount of time before they report it to your credit bureau or to the credit bureau. So working with those collectors or working with those debt collection agencies prior to, even if it's a small payment plan, before it hits your credit. So either way, that's the only other advice that we also offer our clients as well.
That kind of circles back around to the education piece. And we too have been informing our members when we see medical collections, hey, the rules and laws have changed on this, and have given them the time frames. And it's good to see that the credit reporting agencies are working together, to kind of help with medical collections. I've been an advocate for not having them as part of your credit for a long time, and life happens, like you said, and so it's unfortunate that when you're looking to establish credit or you're looking to obtain new credit, that something like a medical bill that may have gone unknown or your insurance didn't pay is holding you back from that. So I'm really pleased to see the progression in the laws that are going to help the consumers with this aspect. Obviously here at TVFCU, we do a lot of mortgages. We help a lot of members with that, and a lot of our community comes to us for their mortgage loans. So how does the credit score impact your mortgage request? You talked initially about maybe somebody's denied because of XYZ. Well, so how important is that?
So very important. So your mortgage score or your mortgage, if when an inquiry is performed, once you guys pull the application for that consumer, it typically only impacts their score 3 to 5 points.
Mhm.
Most consumers think that it brings it down 20 plus points because they'll compare it to a score that they pulled with Credit Karma or another monitoring site from months previous. But overall, it only impacts it 3 to 5 points. Without having a mortgage. So without having that installment loan, that goes into 35% of your overall payment history. So that's why we want, of course, consumers to be able to get qualified or to be able to add that vital piece to their credit profile.
Okay. And so if somebody shops around for mortgage, they contact TVFCU and multiple other lenders, how do those multiple inquiries, because we do pull all three bureaus, Equifax, TransUnion, and Experian, how does that impact their score? I mean, 3 to 5 points each time. I know there's a window where it's not supposed to impact because, we're trying, the Consumer Financial Protection Bureau wants members and clients and consumers to go out and shop around. They want to get a good deal. So.
Of course. And so with that, they do have a window, which is a great question. So depending on what they're purchasing, and of course, in this case, it would be a mortgage loan. They usually have a 10 to 14-day window where that's all condensed into one inquiry. So it won't have as much as an impact of having that 3 to 5 points if you shopped around to 3 or 4 different mortgage loan lenders. So that helps consumers to know, just because you got this is what you receive from this company. If you wanted to get to go to another company to see what products or whatever that they have to offer, it's not going to impact your score vastly much more.
So let's flip the script on that. On a consumer loan, you go into 10 different car dealerships looking to buy a car, and each dealership pulls your credit and maybe runs it through multiple different lenders. Mm-hmm. How does that impact somebody's credit score?
So it's a two-part question. So because if they go to a car dealership, they have usually you have 30 days where that's all going to be condensed. Now, depending on what car dealership, what company that they use. So if it's something with the word financial in it, mm-hmm. That's a separate inquiry. So saying that because we have seen that played both ways. Say, for instance, with Capital One Auto Financing. Versus coming to Tennessee Valley Credit Union to get a car loan. So depends on where that dealership, and it has to be a major dealership, such as I'm trying to think of the dealership. Yes.
Integrity GMC.
Yes, Integrity GMC. So if they're running it to several different car auto finance companies, so it depends on which one that they end up using essentially. So it's the same type of thing to where it would only impact it the 3 to 5 points, but it's going to be condensed. The only way that it won't be condensed is if it's financial that's included in the bank that they used or to attempt to run it to. So they do what we call like a blast call, where they're going to send it out to 10 or 20 different lenders.
So once that car loan is obtained, or let's say in our case, that mortgage is obtained, how does that trade line then being reported to the bureaus impact scores? Does it bring it down and then after some time it brings it back up?
So actually it does. So it'll bring it down because a new account is added, but it will bring it back up depending on how many accounts you already have in that category. So if it's your second car loan or depending on your, if it's your second mortgage, it's not to where it's not anything that you can't rebound from. But it's only going to bring it down a couple of points for the first 30 to 45 days. It usually starts massaging out, usually around month 2 or 3.
Okay. And so, we've talked a lot about trade lines and inquiries and, collections on how you help the consumer. What about bankruptcies and repossessions and foreclosures, things like that? Are there timeframes that need to be considered? Have you had any success with working on items like that?
We have. So we've had a lot of success with working on things like that. So one of the things that separates us from other credit repair companies, first of all, we use what we call factual disputing. So we don't dispute. I would first warn a consumer when you're researching your credit repair companies, seeing how they're disputing things on your behalf, because they are essentially acting as your advocate. We don't use what is a trend as far as credit sweep. Where basically some of those companies advise consumers to take on a new identity. Or get a new credit profile number, basically a new social security number. So those would be cases that would be essential if you're in like a witness protection program or something like that. But for the most part, most consumers that doesn't apply to them. So in reference to the bankruptcies and other public or repossessions or other public things that are appearing on their credit report, we're using, again, the Fair Credit Reporting Act. So it's a more or less a 312-page document that we have submerged ourselves in with using those laws, using other entities such as LexisNexis to be able to get those things successfully removed. Now, again, it does take time. So again, everything is not done in the first 30 to 45 days because it does take a little bit of time, but we have been very successful with doing that.
Great. So again, a lot of information that we've gone over today for our viewers. Any last thoughts or questions that you might have for us?
No, I think you have covered everything as well as the different products. One other thing I would add is with the credit score. I know you had asked about that earlier. So for a client to become approved for a mortgage score, it depends on which product that they're trying to obtain, whether it's a FHA or conventional. And of course, I know you guys offer an array of products for those. So typically we try to get that client to that score that would get them approved for that loan.
You're right. And, you know, in every different product, whether it be FHA, VA, USDA, conventional loans, you know, your Fannie Freddie type loans, even our own portfolio loans that we hold here at Tennessee Valley, each of them have different credit scoring requirements and or, you know, it impacts your interest rate. It could impact your term. You know, there's different things. So, yeah, definitely, you know, reach out to us. Let us know how we can assist. If we have, you know, some information that we can help provide the consumer or our members, you know, if they're needing to repair something. But yes, it does. Everything's impacted by that score in one way, shape, or form. So, well, Cassie, we appreciate you being with us today. You know, and as we wrap up, I'd like to take just a minute to mention that the winner of our $100 gift card drawing will be mentioned in the comments section below. And you can reach TVFCU Mortgage at 423-634-3667 or mortgage.support@tvfcu.com. And Cassie, how can our listeners and our viewers get in touch with you?
So our office line is 423-698-3500. They can also reach us on our website through the Contact Us form to schedule a consultation. And our website is leadyourfinancials.com.
Great. Cassie, we greatly appreciate you being with us today and being our guest panelist with talking about credit reporting and credit repair and just the impact that has on the consumer. And so we appreciate everybody tuning in and viewing our seminar today. And we look forward to next month's seminar.
Thank you for having me.
Thank you.